What is depreciation recapture for real estate capital gains? Imagine selling a property and suddenly facing a bigger tax bill than expected. That's what depreciation recapture is all about. It's a tax rule that kicks in when you sell real estate you've claimed depreciation deductions on during ownership. Depreciation is a way to lower your taxable income each year by accounting for the property's wear and tear or aging. If you own rental property, you can typically depreciate the building over 27.5 years. This means you deduct a portion of the property's value each year, reducing your taxes. Now, when you decide to sell, things get interesting. The IRS looks at your adjusted basis, which is your original purchase price minus all the depreciation deductions you claimed. If you sell for more than this adjusted basis, you have a gain. Part of that gain is from the depreciation deductions you took earlier. The IRS requires you to pay taxes on that portion of the gain. This is called depreciation recapture. It's taxed at a maximum rate of 25%, which is higher than the usual capital gains tax rates. The remaining profit beyond the depreciation recapture is taxed at the lower capital gains rates, which can be 0, 15, or 20% depending on your income. For example, if you bought a rental property for $300,000 and claimed $50,000 in depreciation, your adjusted basis would be $250,000. If you sell the property for $350,000, your total gain is $100,000. The $50,000 of depreciation is taxed at the recapture rate of 25%, which is $12,500. The other $50,000 of profit is taxed at the capital gains rate. Understanding depreciation recapture is especially important for African American investors focused on building wealth through real estate. It impacts how much money you keep after selling an investment property, which influences your overall retirement plan. To manage this tax, some investors use strategies like a $35,000 or higher exchange, called a $33,000 or higher 1031 exchange, to defer taxes by reinvesting in a similar property. Timing your sale in years when your income is lower can also help reduce the tax impact. Another option is turning rental property into a primary residence before selling, which can sometimes lower or eliminate recapture taxes. Holding onto property until death can also be beneficial because heirs get a stepped-up basis, which can wipe out depreciation recapture taxes altogether. Since depreciation recapture can significantly increase your tax bill, it's wise to work with a tax professional who understands real estate investments. Proper planning can help you keep more of your gains and boost your long-term wealth. In short, depreciation recapture is the IRS's way of taxing the gain related to the depreciation deductions you claimed on your real estate. Knowing how it works can help you plan smarter and keep more of your investment profits for your retirement goals.